Hi, welcome to the second video. My name's Craig, and I'm sure you've watched the first video. I hope you visited Bullseye's website and registered there. Please do if you haven't. You're going to benefit from getting a snapshot of exactly where you are. And so this is the second part, and you remember we discussed the wealth pyramid last time, and the pyramid started with the budget and cash flow and net worth, which is your part, and then the second part has to do with risk management, and that's what we're going to look at right now. So let me take myself away here and let's have a look at the actual slides. And we're going to talk really about life and disability and insurance. And so the first question I ask any client is, what do you want insurance to do for you? It's a very important question, isn't it? And has any financial advisor ever asked you that? The fact is, there are, say, 8 or 9 product providers that we can give you products with. Each of them has 6 or 7 different life plans. Amongst those life plans, there's about 7 or 8 ancillary options, maybe 6 or 7 disability options, and you start adding it all together, there's probably about 200 different options that are available to you in the marketplace. And yet, most people buy on price. When is cheaper better? If you wanted to go buy yourself a new Mercedes or an Audi TT, and you went to a second-hand car dealership and he said, here's a car, it's half the price of the book value, you're going to start asking questions, aren't you? You're going to look under the hood, you're going to want to find out if this car's been in an accident, maybe you have an AA report. But we don't tend to do the same investigation when a broker comes to you and tells you to buy a product because it's cheaper. In fact, this is how the industry has developed. If you think about it, Universal Life used to be the product that everybody has. In the last 8 or 9 years, these policies have been replaced. People say, well, you shouldn't have life and investment together. So what will happen is I'll cancel your policy. You can take that cash and go pay it off into your bond and then take a policy for the same value. And that's really what these new generation products are all about. Just to come back to you, what Universal Life was about is it combined cash with life. So some people saw that as a con, and it was relatively expensive in comparison to the new generation products, but that's only initially. In the long term, it's not an expensive product. I'm not saying that you must go back and get your Universal Life product, but I just want you to understand the pros and the cons. The pros are you had level premiums, or you could have had escalating options depending on what product you had. And it built up cash values, and those premiums were guaranteed normally for the entire life of that product. So that's what you had, cash values, whereas on your new generation they simply stripped out the cash values and it's pure risk. And so theoretically, because it's pure risk, you should pay less for premiums, or for the same initial premium you should get more cover. And that's essentially what the guys are selling. They're saying, well, for the same premium we'll give you more cover. Yes, you get the more cover, but that premium in all of these universal products is designed around escalation. So initially you're paying the same premium, but every year it's either got a 3% or a 5% forced escalation. Some balance that with a slight escalation in your cover, but these are how these products are designed. And so in the long term you could be paying more because of just premium escalations. On the other hand, you can look at it and say, okay, well, I only need 1.5 million cover or 2 million cover, so give me the same cover, replace my policy, and you pay, yes, an initial lower premium. But it might take you 6 or 7 years, maybe 7 or 8 years, before the premium starts becoming more expensive. Now, isn't this the problem with all wealth creation? Is we look for the current situation instead of looking longer term down the line. And that's what I'm encouraging you to do. If you've changed your policy, think about it, because new generation policies have cheaper premiums, but cheaper premiums now. In the long term they are generally more expensive. They are more flexible, they do offer wider ancillaries and different disability options. Many of them have very nice disability options, but the cons are there's no cash values. And let me tell you, those old universal policies with cash values, there are advantages to those cash values which I don't have time to go into right now, but they generally have limited or sometimes no premium guarantee. Some products at the end of 10 years you're going to face an escalation. Now some of them guarantee that the escalation won't be more than say 25% or 20%, depending what product provider you're looking at, but I can tell you that when these products come up for renewal, there are going to be escalations, and it's going to frighten many people. it's a bit like renting as opposed to buying. Why would you 20 years down the line, when you really cannot afford to buy a new policy, be faced with having to do so? Maybe you're near retirement and suddenly these premiums escalate, you can't afford it. You're going to be forced to reduce your cover at a time that you can't afford to do so. And so these are things to think about. These products have been easily sold, but not always the pros and cons easily explained. So why is cheaper better with insurance? Whereas we know in every other area of life, there's something you're sacrificing when you pay less. And so the question is, what do you want insurance to do for you? If cost is the only factor, then yes, go for the policy that you've probably been sold. My preference is something with cheaper premiums, relatively cheaper premiums, give you that flexibility and the auxiliaries, but I want a guaranteed premium and I want guaranteed cover for life. In fact, I don't want to worry about life cover when I'm near retirement. When I'm 60, when I'm 65, I don't want to worry about having to pay life cover, but I want that cover there for my family. Okay, some people want term and they'll cancel their life policy, but let's face it, if you cancel your life policy on the new generation product or you can't afford it, all your payments you've paid are gone. At least with the old universal policy, you'd get cash values back. And so I'm quite happy to sacrifice the cash values, and so I would look for something like a standard paid up plan, where instead of paying, say, in fact in the current product it's cheaper, but let's say you would pay sometimes up to double, maybe 20-30% more depending on what product house you're looking for. You pay a premium, and then at the end of 20 years or the end of age 65, the premium stops, it's paid up, but I've got my life cover guaranteed for life. Accelerator with a lock-in, that's another option. So I pay a lower premium now, but it locks in at a certain level premium by, let's say, at age 65 as well. I don't have to worry about my premiums going up, and my life cover is guaranteed. In fact, in many cases that life cover escalates. So there's a lot of options. What do you want from insurance? That's the question. Just quickly before we end this video, liquidity management. We spoke about an emergency fund in the first video. Please, if you haven't done so, that's the third step. I'm going to help you look at your life and see what you can do about it, but you need to also think about this liquidity management. It's very important that you have at least 3 months cash available in maybe a cash account, money market fund, and you have at least 3 months of credit available to cover any unforeseen expenses if you lose your job, etc. So underneath this little video you'll see that there's a little link. Please download it. It's a PDF form, fill it in and fax it through to me. The fax is on the top of the paper, and I will prepare a personal life cover report for you to tell you the pros and cons of the plan that you currently have. And if you'd like to discuss it, there is a little tick box where I can contact you, or we can have a web conference at no charge. Thank you for listening.